Hi, folks. It's Roland Kym here, Vancouver Realtor and Vancouver Asset Specialist, here to help you grow your wealth, your asset, and doing that through real estate bullion and many other passions of mine. Today, we're talking about real estate. So, today, we're talking about what to remember when you're buying a real estate investment property, 21 key insights and items to remember and think about. Simply, these will hopefully help you make a better investment in your real estate purchase in the future. And if you haven't made one in the past yet, hopefully these are new items that you keep front of mind. Number one, define your investment goals. It's kind of like what I say, define your investing avatar. So everyone has a different reason why they're buying, be it cash flow, be it location, purpose. You really need to figure out what is the core reason and multiple reasons why you're buying an investment property. They could be long-term rental income versus short-term capital gains. You need to clearly outline your financial and lifestyle objectives, because if you don't do this, you might be in a perfectly good investment property that other people would love, but it doesn't work for you because it isn't the right equation. It isn't the right avatar. So spend a bit of time figuring out really, why are you purchasing an investment property? Why are you going down this path? And what does it mean to you? And what is it that you're looking for? Point number two is assess your financial readiness. You got to secure a pre-approval for a mortgage. You got to ensure to have the funds for a down payment, closing costs, and maintenance reserves, and you got to make sure that you're ready. If you're heading into a lot of financial or emotional big pieces coming up, like you're getting married or perhaps you're upgrading your primary, you might want to consider, slowing down purchasing your investment property. If there's too much on the horizon, equally, you want to make sure that you're at the right life stage that buying an investment property makes sense. Number three, choosing the right location. So you want to focus on areas with population growth, strong metrics like strong job market, just solid demand for rentals, and you want to consider the proximity to amenities such as public transportation, services such as shopping, all that keeping in mind what you're paying, what your budget allows, and it's a balancing act. Number four, understand the market trends. And so here's where you really need to be working with a realtor. For the Greater Vancouver market, I can help you. I own multiple investment properties with my wife, and I love helping folks buy investment properties because I think it's one of the most amazing ways that the average Canadian can build their retirement. I mean, there's very few things, well, there's no other thing that I'm aware of where you're putting 20% down and you're getting the growth of fivefold of 100% as the market appreciates. And that's pretty darn amazing. So you need to study local market conditions. You need to understand what the price appreciation trend is, where the rental trend, the demand, is it going up? Is it going down? Are rental rates, fixed, kind of frozen, or are they increasing? What's the vacancy rate? Again, Greater Vancouver market area, I would love to help you anywhere across Canada. I have affiliated partners that would love to work with you that you can reach through me. Just reach out to me. Number five, decide on the property type that you're going to purchase for your investment property. Everything from single family homes, condos, multifamily condo buildings, commercial properties, they all have different price points. They all have pros and cons, and they have to match the property type to your budget and to your investment goals. Important to understand. Evaluate your rental income is point number six. You need to calculate your monthly rental income that's expected and research that through comparables in the area, through speaking with property managers, through speaking with realtors like myself that can give you some insight. So really evaluate what the potential rental income is going to be and on a specific property when you get to that point. You need to calculate the ROI, which is called return. Your ROI is the expected monthly rental income that you're going to get. Research comparables, again, really understand the rental rates and the rental trend in the area you're purchasing for the property class that you're purchasing at the time. Budget for upfront costs. Upfront costs are kind of what we call friction costs. It's the down payment. Well, down payment is not a friction cost, but upfront cost is your down payment. Friction costs would be legal fees, would be realtor fees, closing costs, property inspection, move in, move out, those kind of items. Plan for ongoing expenses is point number nine. Property taxes, ongoing maintenance, insurance, which is ever increasing in this global climate that we're in, and property management fees. Those are all ongoing expenses to own and manage investment property that have a direct impact on your bottom line. So you need to factor in also potential vacancy and unexpected repairs. Potential vacancy, again, simple. It's times where you don't think your home's going to be vacant, but someone gives notice and it takes you a lot more time to find the right tenant. And unexpected repairs will be those typically major repairs on the exterior, on the main systems of the building. If you're buying a strata, it's often expenses that you don't have control over. It might be new windows, roof, envelope, foundation, parquet, those type of upgrades that when they do happen, they are costly and your portion is substantial. Point number 10, conduct a thorough inspection. Don't buy a property without an inspection. You want to identify main structural and system problems that you didn't see or weren't aware of. You want to use your inspection results, if available, to renegotiate perhaps a price or a repair list. What the goal is with an inspection is you want to, if you've done due diligence working with a good agent and have some experience, you should be understanding what to expect for the price that you're paying, for the age of the building, for the area that you're buying. Obviously, when you're buying a 25-year-old unit in a building, not everything's going to be perfect. You can't have expectations of what you would have if it was a 2-year-old building. So you got to keep that in perspective. The inspection is really there for you to have the most amount of time to view a property with professional help prior to you making a decision of buying it, and then that problem potentially becomes yours, and it's going to outline all the little imperfections. It's kind of like a history report on a property where it would identify at that point in time everything that's broken, scratched, and wrong, and you get to make the decision, is this still something that you're looking for? Of course, that combined with the major systems and structural systems that you want to make sure are all in good standing and order. You want to research zoning and regulations. You want to identify the slide didn't update. So you want to understand the zoning, what is allowed currently, perhaps what will be allowed in the future, what are the current regulations, what can you do, what can you not do. Really important if you want to do something specific like nightly rentals or you just want to make sure that you understand what you're buying, what the regulations are, and what the zonings allow and don't allow. Point number 12, secure the right financing. There's so many different options to finance an investment property, especially if you own your primary and if you have a lot of equity in it. You want to compare loan options, fixed versus varied. Consider working with mortgage brokers who can, farm out your position, your portfolio to a number of different lenders and get you the best rate. And, there's other options, perhaps like a HELOC or a line of credit, or who knows what might be available to you. But go do the research on how you can finance your investment property. Point number 13, understand the tax implications. In Canada, primary residence does not have capital gains on the growth. Investment properties certainly do, beyond a certain annual amount that is they all do, but the rates change, and that's another point. Really understand the tax implications of purchasing a property. What is deductible expenses that can benefit you in the near term, and then understanding capital gains taxes that you'll be paying in the late terms of owning an investment property. Understand, how depreciation is accounted for in your annual taxes. So as you're getting into investment properties, unless you're an amazing tax authority, I would certainly invest in a great accountant and make sure that they understand what your vision is and what you're doing, and get the help you need so that you get the best tax efficiency available and the best tax advice. Point number 14, assess property management options. Yeah, you can decide to self-manage or you can hire a property manager. You got to calculate those fees into your evaluation. A lot of property managers now are evolving. They're understanding that charging 10% ongoingly for a rental unit that is just sitting there and the tenants, not a problem, nothing is happening, and just every month paying 10% to the management company might not be a fair equation for the landlord, and they might not be interested in doing that. So there are a lot of management companies out there that have multiple different options. So do investigate that. I know of locally great management companies in the Vancouver area that have a placement fee, for example, where they charge you a certain amount to find an amazing tenant, and then they hand you back the management of the property. There's ones that offer a reduced management fee for certain services. The spectrum of offerings is opening up. Just understand what is important and understand as well what is the reality for you. If you're the type of person that really doesn't want to ever communicate with the tenant, doesn't want to meet the tenant, doesn't want to be hands-on in either doing work or connecting with a person that does the work, you need a property manager, but it does cost a fair amount of money, and that needs to be calculated into your equation. Point 15, analyze the risks. Analyze market downturns, vacancy, or unexpected expenses. Other things as well as fires, deaths in the property, floods, so many different risks that are out there, and you need to figure out how high is that risk being realized in the property that you're looking to buy. Doesn't mean you're not going to buy it, but you need to understand what the risks are equally because you obviously know what the opportunities are. That's why you're buying it. But don't only be focused on the good, understand what the risk is and how you can mitigate it. So have a contingency plan in place and save up an emergency fund. Really important. Point 16, build a team of trusted professionals around you. Realtor, mortgage broker, lawyer, tax advisor, property inspector, plumber, electrician, mover, uh, you know, uh, roofer. So many people that when you need someone, and if you don't have an information packlet all put together in advance, it's hard to find the right people. And these folks, especially if you're going to buy multiple properties, really appreciate long-term relationships and will provide you with exceptional service over the course of you being a landlord. Again, strong team allows you to make very smart decisions. Point number 17, consider future development. Investigate planned developments or infrastructure changes nearby because it can affect you positively, but some folks don't necessarily see, development increase as positive. For example, if you're a person that wants to make sure you're never going to have to move out of development, make sure that you don't buy a development that is nearing the end of its life in an area where it's highly underbuilt and could be zoned and sold for redevelopment. Because if you don't want to move again, you want to make sure, or investment property, if you don't want to have to find another one, you want to make sure that you understand the good and the bad in the future of development and what's happening in the area. But for the most part, if you're buying investment property and you're solely looking for ease of renting and safety and buying a good structure, typically when the developers come and future development density is allowed, that's a positive thing because you're going to get anywhere from 30% more to multiples more of what the market value is if you ever get bought out through a land development opportunity. And to that point number 18, think long term. Real estate's a long-term investment. Don't buy an investment property if you have a horizon less than 5 years, because there's a good chance that you will not cover the friction costs that we covered earlier if the market has modest or no growth. And focus on the future. After 5, 10, 15 years, it's amazing when you look at the mortgage document and you see how much now is principal versus interest from the front-loaded years. And you'll wish you bought more investment properties 10 years after you purchased one. I promise you that, because then it gets easier and you just understand the opportunity that it made for you. Point number 19, negotiate smartly. Use inspection results, market conditions, and comparable sales to negotiate smartly. Be prepared to walk away if the deal doesn't meet your goals. Equally, don't be stubborn. Like, negotiate smartly does not mean just be a bully and arbitrarily as a buyer come up with a price that if you don't get, you're not going to buy the property. Often it's good to have a plan. It's good to have, an over eager and optimistic price point that you're hoping to get the property at. But necessarily, if the seller doesn't go there, they might still go to a place that's still a really good investment. And I've seen too many people walk away from great opportunities because they couldn't get the price they wanted, because they arbitrarily came up with a price that was not what I presented to them, and it was not market conditions. And years later, they didn't own that property, and that property had much more appreciation, was much easier to manage, was simply a way better investment. But my clients didn't negotiate smartly. They just negotiated heavily and without common sense or market influence. So do be your own best critic in that situation and really figure out what's important to you. Point number 20, plan for diversification. So avoid putting all your resources in one area if you're buying multiple properties. Figure out what is most important to you. Often it's a diverse portfolio is one of the safer ones. We've certainly seen it in the global or national environment where issues happen in a certain city. It could, if you had all your investment properties in that city, it could impact all of your cities, all of your investment properties, versus being diversified, potentially having investment properties in different locations. Yeah, that is important as you grow your portfolio. Point 21, monitor and adapt. And this is really key. It's not a set and forget kind of thing. A lot of people buy a couple investment properties or one investment property and they sit on it for, 20 years, don't do anything, and then they go and sell it. And I can promise you that's a great outcome. I can promise you if you bought an investment property and 20 years later you go to sell it, you will never say, I wish I didn't buy that investment property and I wish I didn't have all this appreciation and principal pay down. However, you might look back, and if you could, at different points of time over the past 20 years, you might realize you could have repositioned your investment in that property into something else. You could have diversified. You could have pulled equity out and bought more. You could have avoided upcoming assessments by leaving an investment property earlier. And so the point there is continuously review your investment's performance, adjust your rents, refinance, renovate when needed, and maximize your return by being creative and working with your realtor to figure out, is this still the best use of my investment dollars? And is this the best investment property that I want to hold on to? Or could I get more leverage, more opportunity by, adapting? So real estate investing is one of my passions. 20 years ago, I didn't qualify for a mortgage. And 20 years later, my wife and I have double-digit properties because every time that the bank said we could borrow a little bit more, we leveraged and we did calculated risk. We spent below our means and we reinvested any cash flow back into the properties and kept leveraging into them. And it is an amazing path to be on because you're offering great housing to the rental market. We are great landlords, and it's one of the best investment strategies we've ever made. So real estate investing is, again, one of my passions of mine. With what I'd love to do is help as many regular folks buy one or two investment properties, often pulling equity out of their primary home, because I know 10 years down the road, the impact that's going to have on their lifestyle, on their retirement, on the ability for them to finance and fund items for their kids. It's simply powerful and amazing. To that end, do follow me on Vancouver Realtor Roland Kym on YouTube. And if you haven't already, please subscribe so you get updates on all the different things that I'm sharing related to being an asset specialist and a Vancouver Realtor. I appreciate your time. Have a great day.